Anyway,
Well,
I'm Todd Phillips. I am a tax attorney by trade. I own some tax-related businesses. I'm an entrepreneur by nature. I started my career working for what you'd call a tax think tank. It's called the National Office at one of the big firms. It was a wonderful experience for a young person to dig in and read the tax code and the regs and the case law and learn how it all works together and craft that into an argument or into a strategy or out of a strategy, depending on what the situation was. But I learned early on how to do this business, and I've kind of been doing it ever since. But I haven't done it just for my clients. I do it for myself, and I do it in a business sense and execute on them. So I've been around, 360 degrees of the whole thing. So I'm going to try to share practical advice along with, I'm not advising you, any of you watching, as your attorney. I'm not your CPA. I can only give you ideas here in this format. It's up to you and your team to implement them. And if you want to be on our team, then that's great. I'm going to leave my contact info at the end. More than happy to talk, but you can't take what I tell you here and go off and execute on it and expect it to be a legal opinion, because it's just not. This is just education. It's very broad. Sorry for delving into that. Dan, I got Dan Werry with me. I'm going to let him talk about himself a little bit, but Dan and I have been working together on clients. And you're going to see that we both have similar company names. Literally purely coincidence, but neither of us is backing down from the argument. So I thought of it first. He'll say he thought of it first, but we've been working together apart for 20 years, right, Dan? And in this realm of helping people solve their tax problems, helping clients reduce their tax burden, increase their worth across a number of things: real estate investors, business owners, retirees, people just getting started out. We've done the gamut. We do the gamut. We're here to help, and we're here today to talk about last minute tax strategies. Dan, a little bit more about yourself and your background, because I kind of brushed over.
great. Thank you, Todd. And similar to Todd, a little house cleaning. I cannot provide tax or legal advice, and happy to spend time and, as Todd mentioned, create some ideas. Been helping clients now for 35 years. So 35 years of real estate and investment real estate experience, 25 years of tax mitigation strategies with investments through 1031s and other income and passive income strategies. And ultimately, most of the code is favoring real estate investments and or real estate professionals. And I think Todd will probably touch on that. So most of the code is spent in that area, and or tax efficiency and or energy strategies or tax credits. So that's where I spend most of my time, helping mitigate tax problems, either through passive income, 1031 DSTs, tax credits, charitable donations, you name it. There are great provisions out there. Really enjoy what I do. Happy to elaborate whenever possible. Thank you, Todd.
I'm glad you brought up some of the different avenues, paths we can go down, because I think that's important. We have a pretty good playbook to work with from the government right now, but what's changed over the years in my tenure, 1986 was when Ronald Reagan put in, or Congress and signed by Ronald Reagan, the initial restrictions on passive loss rules. So they created that real estate sort of world that exists now. Before then, it was open to everyone. And so post then, they shrunk the box. So since 2017, the first Trump Tax Act, to today, they've been changing the size of the box and moving it on us as professionals. So a lot of what Dan and I do is trying to interpret where are the opportunities right now, because they're not the same as they were 12 months ago, and they're certainly not the same as they were 10 years ago. That said, some of the same concepts apply year over year. So we're constantly kind of figuring out where the sweet spots are. Like what Dan was alluding to, there's a lot of sweet spots right now, but they're diverse. They're not all in the same bucket. And it's, as you pick and choose, there's some interplay between them that's really important to understand, so that you don't end up doing one thing over here that hurts you over here. I just had a client conversation this morning that did a tax move and then just realized it's going to come back to bite them in another spot. Well, should have talked about that before. Hopefully you can see the PowerPoint. The thing I'm going to start with, Dan, can you see it?
Perfect. And we should probably check also a little housekeeping. How is the audio? Maybe somebody can give a response on the chat.
Or a thumbs up, or text one of us, whatever you want to do there.
I want to make sure there's no echo.
Anyway, while that's happening, the first thing I wanted to go over is this myth. I get phone calls all the time and emails and intros. People think we have a magic wand that we can somehow, as tax professionals, put the number in the right spot in the tax return and that will somehow benefit you. Or can you review what my CPA did to see if there's more deductions there? And that's not how tax planning works. That's reactive, not proactive. It's very, very difficult to operate in that kind of a manner. The reality is tax planning is a game, not a game. It's a business in and of itself, right, Dan? Like you have to actively do things. You have to get involved in your tax situation. And lots of times that means you're investing, you're working alongside your money, you're making certain decisions in regard to your business. It's not something you can passively sit back and hope that your advisor does on April 15th to wave their magic wand and make your tax problem go away. So most of the stuff we're going to talk about is going to require some work on your end and some work on our end. So I wanted to kind of dispel with that myth. But Dan, have you seen anybody come to you and just say, hey, can you just make my taxes go away?
Of course, the challenge is, yes, 12 to 24 months ago.
Exactly. Or, hey, I just sold my business. I need some strategies to fix the tax. Well, we should have talked 5 years ago, 10 years ago. We probably could have done more than we can do today. Anyway, sorry, I'm digressing and preaching, and I'll probably do that a lot. Okay, let's dig into this. Dan, I think this is kind of my part, but everyone on here, I think you should chime in on that you have experience with. But what I wanted to get out of the way, first of all, is the simple stuff. So we titled this Last Minute Tax Strategies. So things you can do in the last 15 days of the tax year. So I want to just cover those real quick. If you have questions, I'm available. A text, email. I'm happy to bring out as a client and make sure all of our clients, we run through 150 tax strategies for. So we run through them all. These are just kind of some simple year-end ones, but we check all the boxes that we possibly can. But here's the quick highlights. Number one, an HSA, a health savings account, is better than a 401k. So if you are sitting there wondering, should I put money away? Max that HSA first before you do anything else. That's going to qualify as retirement money and medical money, and you can take it out tax-free and you can put it in and get it. They call it triple tax-free. It's a home run. It's capped at a relatively low number for high net worth individuals, but whatever it is, fill it up. Do that before you do your 401k. Then we're going to talk about things other than 401k that are even more beneficial.
And the nice thing is,
go ahead, Dan.
Is you can self-direct that. You don't just have to stay in the typical equities. So just find an HSA account, and Todd or I will help you with one because I do the same thing. You can self-direct that to investments that might be either more favorable to stability, income, and growth. So I think that's nice. And then I think Todd said you may need to have that in by December 31st. And are there two levels, Todd? Individual and joint, and then they have to be the the highest deductible plans?
Yeah, yes, there are so many details. I'm not going to get into the details. That is the rough end of it.
But we both do it.
Make sure you figure out what your maximum is and that you're not going over that.
Yeah, and we both do it. So if you have a question, call us and then we can
do the math for you.
Direction. Yeah.
Next one on my list, real quick, just going to burn through these. Prepaying vendors. As a tax person, I always remind my clients at the end of the year, you can prepay your tax guy. You can pay your bill for next April right now, and it's deductible this year if you're a cash basis taxpayer. Feel free. Not enough people take advantage of that. My bank account will tell you.
Limitation would have to be a liability for the current year, so not the next 3 years, 4 years. It would be the current year.
12 months. Yeah, it's got to burn off, right? So you can't prepay 10 years worth of tax. That'd be nice. But then I'd have to pick it up in income. So let's be careful how aggressive we get. But good point, Dan. Super fun 529 plan. My office, we were talking about this last week. They put in a rule, I think it was in this latest Trump tax bill, where if you overfunded your 529 plan, that's your kid's education plan, they can convert it to a Roth IRA. And I think the limitations are 25,000. Please don't quote me on that. But what a way to give your kids a head start, right? You put in some college money. If they don't use it, it could sit and grow until they're 65 years old, and then it's a Roth. So when they take it out, it's entirely tax free. I wish I had one of those at 65 years old that somebody had started when I was 2. Right? Talk about your ultimate compound gains and returns. So super funding 529 plan, I would say HSA first, that second. Dan, deferred bonuses, deferred comp. You have a lot of clients that go to their employer and say, hey, don't pay me that bonus. I'll take it next year.
Right. Yeah. So if you've already had a good year and you have what you need to get you through the next, 2 weeks, maybe push out some income into next year so you're not taxed in it this year. One other concept on that, if you're self-employed or a small business, would you pay your taxes from your state taxes from the business so it doesn't go into the SALT tax?
Yeah, I think that's a great one. Hopefully you have a good accountant. You're already doing the pass-through entity tax, PTE. Not every state allows it, but our great state that Dan and I are in Minnesota does. One of the few favors they do for us. But you can avoid the SALT cap. Now the SALT cap's up to $40,000. But if you're a Minnesota resident, Minnesota phases out your itemized deductions. So a whole nother reason to bring it back in. So if you're earning $1 million a year, you're not getting much for your itemized deductions. You're only getting like 20%. So great time to really consider that if you have a pass-through entity, the PTE tax. But yeah, if you're an employee, the deferred bonuses, deferred comp work great. Or if you're the owner of a C Corp, you can defer some of that stuff. Of course, the C Corp is going to pay the tax. So, all right, harvesting existing losses. If you have we call it a taxable account. If you have a trading account where you can easily buy and sell things, and you're not sitting there in December trying to figure out what has losses in it that you don't necessarily need to hold anymore, you're missing opportunities. Assuming that you have the kinds of gains or income that it can offset, harvest those losses.
So is that capital loss against capital gain?
Yeah, the capital loss carry forward rules are a nightmare. So make sure that you have something that it can offset before you trigger losses that you can't use.
The question, if I know that in the next 3 years, so 36 months, I'm going to have a capital gain, can I harvest a loss today? So a capital loss, and then offset that when that gain comes out in the future?
That idea. Now think about if you've got some real estate that Dan and I deal with this all the time. 1031 exchanges. I'm going to buy 2 DSTs. I'm going to buy some oil and gas, and I don't know what to do with this last 100,000. I kind of would like to cash it out. Well, what if you had some built up losses that you could take some cash out of your 1031 exchange account because you're planning ahead? I like that idea a lot. Okay, 2 more. Bunching charitable giving and donor advised funds. This is a cool deal. These aren't going to make anybody wealthy, but itemized deductions it's one of those boxes that I was talking about to keep moving. Like it's the IRS's moving target. So how do we, hit it just right? And a lot of people were bunching charitable donations. They'd be like, okay, I usually give my church 10 grand a year. I'm going to write them a check for 100 grand. And now I get one big deduction. I don't have to worry about the little itemized limitations or all these other things. I just one shot at it. But then we came up with these donor advised funds. So now instead of giving them the whole check all at once, let's say you give them 10 grand a year. You make your donation at once, but then the donor advised fund is going to make those timely distributions over time. But you've bunched your charity into one thing. So right now, if you're thinking charity at all, you don't have a donor advised fund, you got 12 days to set one up.
And Todd, you're familiar with the charitable donation programs that I work with?
Yeah, that's on the next slide. So I'm going to let you run with that one in a second. Perfect. Or go ahead and go with it now.
Well, I just wanted to see if it would qualify under that bullet point, but that's a similar situation where there's different limitations up to your AGI. So depending on what your donation is, what it's going to, you can deduct up to 60% in some cases. So 60, 50, 30, and then you can donate a certain amount, and then that'll reduce your AGI up to those percentages. So different clients will look at it for different purposes, but that's one specifically. Work with Todd, work with myself, or your own CPA, and if you have questions like that, it's unique.
I'm going to beat a dead horse, and hopefully I don't offend any animal lovers. I don't really mean a horse, but like like what you just said, working with professionals so you don't miss these caps. Yeah, it's really important. Last one, fringe benefits. I just had a conversation about this morning as well. I'm going to talk on the next slide about C corporations. C corporations have come back in style. When I was getting into this business, you didn't start a C corporation. I had one as a client when I was in my early 20s, and they had a very specific reason to do it. And I remember going to the partner in charge. I was like, "What are we doing here with this C corporation?" He explained it to me. It was a narrow set of circumstances. It made sense. But for years, you're going to get hit with double tax. Don't do a C corp. Don't do a C corp. Don't do a C corp. Because the math was different. But now the math, there's some things we'll talk about on the next slide. That the math is better. But now all these fringe benefit things are back in play, right? So S corporations and partnerships or LLCs, the things we talked about, the pass-through entities, have more restrictions on fringe benefits than a C corporation does. So if you're an employee, negotiate the heck out of your fringe benefits, the ones that are tax-free. And if you own a C corp, it's time to maybe start looking at what the C corp can offer for fringe benefits. That's enough on that without getting too esoteric. Dan, we're getting into the good stuff, right? Next slide, the good stuff.
I was going to say, I don't want to.
I'm going to let you lead this one off, but tell me what kinds of things you're seeing with bonus depreciation.
Perfect. And I don't want to scare anybody away, but if that was the easy stuff, and now we're into the meat and potatoes, hopefully we're going to enjoy the ride. So bonus depreciation.
I meant beneficial.
Got it.
Not
so
easy.
Bonus depreciation, typically a 20-year asset or less, you can write off the entire value the first year that you take it. So, and maybe Todd will get into when that was increased. But if you buy something for $1, put 50 cents of leverage on it, now you're writing off, the asset is $1, you put 50 cents of leverage, you can write off the full $1, and you only invested 50 cents. So now you're getting a significant benefit to write off your active or passive income, depending on how you can participate. So Todd, maybe you can go in what the requirements are there.
It's beautiful. I think, just to reiterate, and if you all have heard me speak before or seen in my videos, bonus depreciation is absolutely the most powerful tool that Congress has built for tax planning that's ever existed in my entire lifetime. Bonus depreciation, number one thing that you have to take advantage of. The hardest part is fitting it into a box that fits your personal tax situation. So you can buy an asset, you can depreciate it, but if you can't use that loss, what Dan was talking about is, this is a paper loss, right? You've depreciated it. You've bought it, you placed it in a service, and you depreciate it. If you're restricted by what started in 1986 with passive activity rules, and today has excess business loss limitation rules piled on top of that, if you can't use it, you are not going to get the benefit this year. Now, in some of those cases, it carries with the asset on forever. In some of those cases, it turns into a net operating loss. It's not lost forever. If you made this mistake, I'm sorry. But point being, first step, make sure you can use it. I'll get into a little bit on that. But yeah, Dan, don't you think? I mean, how many of your clients right now have a strategy that involves bonus depreciation?
Many of them do, and more are taking it on, especially after the big, beautiful bill was passed. So the distinction or the contrast to Section 179 cost segregation, which you can really use like a scalpel, bonus depreciation goes in as just a full block of depreciation. And Todd said, if you have more than you need, you generally can't create a loss and carry that forward to benefit from that. But bonus depreciation can be utilized for other real estate income that has such a low basis that you're paying tax on it. So bonus depreciation is a great opportunity there. But I do want to touch on either material participation or real estate professional. And if you're talking about those later, I'll do that.
We can jump in right now if you're ready. Go for it.
Okay. So bonus depreciation, if it's an investment that you're basically a partial owner, you'll need to have at least some type of material participation documentation, which we have strategies to help you there to make it very streamlined and efficient. But material participation generally means 100 hours or more. And then real estate professional, if you're already a real estate professional, you know the definition and you're filing it on your tax return, but 750 hours or more, and that's generally your primary occupation. But what's the other benefit, since we brought up real estate professional, what's the other benefit of being a real estate professional?
I'm not sure what you're driving at besides.
W-2, your spouse, if your spouse has, and you've married filing jointly, if you have W-2 income on your tax return or other active income, you can help offset that if you're a real estate professional.
Up to $626,000 in 2025 if you're a married couple. Half that if you're single.
The
Business loss rules.
The last distinction on bonus depreciation, some states recognize it. So in Minnesota, it's a 5-year recognition, so 20% the first year. I don't know how California does it, but it's not the same either. So some states recognize bonus depreciation and some do not, or they do it in a tiered, laddered fashion.
Yes, our tundra up here in Minnesota, it's over a 6-year time frame, which is a bummer because sometimes those assets are 5-year assets, and you're like, wait a minute, I think I just made things worse for myself in Minnesota. But the federal tax is usually, 2 to 3 times as much, so it's usually worth it. But back to passive loss, Dan. I'm glad you brought that up. There's so much misinformation out there. You said one thing, and I'm not going to pick any, but you said 100 hours. The real test is 100 hours and more than anybody else. You have to be careful when you look at these opportunities to invest. So the way to get active, though, this is the one thing that very few people fail to grasp, even CPAs, okay? Rental income, rental activity, rental income and loss is a passive activity per se. You cannot actively participate in real estate. And people look at me like I'm crazy. Well, why do you follow these active participation rules? I'm telling you, it's right in the code. You cannot actively participate in real estate. Okay, what you can do is get around the rules that require you to actively participate in the business. And then they bring you back around to the active participation rules. So let me explain. One workaround is that you're not in the rental business. Okay, I'm sorry, it's not rental income. It's not long-term rental income. You're in the rental business. So if you renting things out like an Airbnb where your average renter usage is 7 days or less, or if you're leasing automobiles as a Turo owner, RVs as an outdoorsy owner, or if you're doing equipment rental, like short-term equipment rental, like bobcats and chainsaws and things, if it's less than 7 days, if it's 7 days or less, that's a trader business. So it's no longer rental income. Be careful. It's now subject to Social Security and Medicare taxes because it's your business and you're doing it. That's the active participation Dan's talking about, 100 hours and also more than any other individual. So if I hire a property manager and they're a different company, they're like, oh, they're not in my company. I work more than anybody else in my company. Well, but they have their own, but they're an individual and they're working on your rental, whatever it is. You have to work more than they do. And so you see a lot of these sponsors out there saying 100 hours or more, but they forget that and more than anybody else. You got to manage that. And you got to make sure that it stays short term. Okay. So we'll call that keys to the kingdom number 1. Short term rental, actively participate because it's not a rental, it's an active trader business. Keys to the kingdom number 2, the big dog, the one Dan and I have been doing for years and almost all of our clients have been doing, real estate professional. So you hit on it, Dan, 750 hours. There's some minutia and details in there. You can't just be a real estate broker and be a real estate professional. You have to also actively manage those properties or be involved in those properties. So the 750-hour test, you have to work in real estate 750 hours. It has to be, in most cases, like new construction type things or brokers or things like that, right? You have to work in the field of commercial real estate, can be residential. But then they have to spend 500 hours in your rental portfolio, and you have to aggregate those properties together if it's more than one property. So real estate professional, much harder to meet than the short-term rental rules. But that allows you to get everything on the long-term rentals. It doesn't allow you to do equipment leases or auto leases or anything like that. Those are out for real estate professionals unless they're short term. So you can see there's multiple sort of tests at work here that interplay together to be able to use that bonus depreciation. But why we included bonus depreciation today, you only have to place that thing in service on December 31st. You have to place it in service. There's this video that's famous in my mind. I don't know if you all saw it, but Grant Cardone on LinkedIn is saying, I ordered a plane on December 31st and sent him a deposit. And I'm thinking there's going to be an IRS agent that's watching your little video and is like, I guess we got ourselves an audit candidate here because this guy just thinks he bought a $5 million deduction and he didn't place it in service. So you have to be careful there. Bonus depreciation, but this is the great thing. You didn't have to buy it way earlier in the year. You place it in service 1, 2, 3, 4 days. It counts for the whole year.
One other quick question on bonus depreciation. Do automobiles are heavier than what, 6,000 pounds or so? Do those qualify for bonus depreciation?
To be clear, the auto strategies are dependent on what you're using it for. If it's for your business and it's an auto, you've got all of the auto limitations. You're going to do better with bonus depreciation than you did under Section 179, which still exists, by the way. They didn't go away. But there's still limitations. So if it's a luxury auto, you're limited. If it's under 6,000 pounds, if it's over 6, if it's got a pickup truck bed, all of these things, the different buckets are going to get you more bonus depreciation. And some of them will give you full depreciation.
Sorry, how much of that is professional use versus personal?
Yeah, and then you have that problem as well. So what I was recommending though is like being a Turo company, right? Get into Turo is just like Avis, except you're the Avis. You put your car in the Turo rental program. People go on their app, they pull up Turo, they see the car they want, they're renting it from you. Now you're in the short-term rental business. Now none of those luxury automobile rules apply. I'm trying to find I think I found my candidate, but a luxury automobile company to go do some events with. Like, let's go look at fancy, Ferraris or Lamborghinis. But the reality is you can buy one of those and deduct the whole thing if you're willing to rent it out to strangers. And for the time period that's in the program, you're not using it personally. You can convert it later, but for the time period that's in the program, you leave it in there because you want to get 100%. You don't want personal use. I feel like I'm rambling on, Dan. We've gone over quite a bit in that amount of time. I do have 5 other bullet points here. Do you want to get into your charitable strategies? I don't know how much you want to disclose about how the details of how they work, but maybe talk about some of the deductions you've been able to generate.
Sure. So, of course, everything requires a certain amount of research, due diligence, and vetting out the process. But yes, depending on what your charitable donation is going for, so cash, I think, is up to 60%. Most charitable donation deductions, 60% of your AGI. Is that correct, Todd? And if it's your typical charity, then it's 30%. There are some charitable donation programs where, depending on what it's going for, if it's not, I want to say, materials and inventories, and if it's more IP, intellectual property, then it can go up to 50%. So long story short, you donate $1, you can write off $5 up to 50% of AGI, of your adjusted gross income. So that's just one option. So your donation's going to a great cause, and then you're also mitigating or lessening your tax burden.
And those are out there. People are doing those right now every day. I don't know what's on the market right now. It's probably not for us to disclose here, but if you have a desire to do that, Dan's got places where you can make that work for you. Okay, loss harvesting. This is the one that I'm starting to sort of, because I'm involved in a REIT now, and we're trying to really maximize the way that people can get cash out of their real estate tax free. But loss harvesting is a fun one. So we talked in the last slide about if you have a portfolio of taxable investments, you can sell off the losers. But there's these wash sale rules where you can't like rebuy it the next day or rebuy it. Sell it December 31st, rebuy it January 1st. There's a holding time frame where you got to stay out of it. But a lot of people like Dan and the people that he sells products into have loss harvesting funds now. And I looked at one the other day where if you put $100,000, your first year, you're probably going to generate $30,000 to $35,000 in tax deductible losses, because I'm not going to get into how they do it, but they're selling every day. They're selling losers every day. and they're not reinvesting in the exact same thing, but what you do is you get an overall S&P style portfolio, and they might sell Pepsi and then buy Coke, right? There's an active manager in there figuring out what's within the rules, what can they do, and how can they harvest. The gains stay the gains, and the losses work through. And then there's other people out there that are doing this with options and with leveraged funds and all kinds of really cool strategies to maximize loss harvesting. But that's capital losses, right? So you have to make sure you have capital gains to match that against. Any thoughts on that, Dan?
Yeah, just one unique component. If you do sell Coke and then you think it's down, I think you can buy an option for Coke and the money and then exercise it going forward, and it would qualify. So unique, not giving tax or legal or investment advice here, but there are some unique components that can be fun.
Yeah, I would say don't do it yourself, right? Like there's good companies out there that manage it very closely, know the rules inside and out, and all you got to do is give them your money. You don't have to be actively involved in that. So that's one thing. Let somebody else do it. 3 other things here to go through, and then we can take questions or go through some of the more unique scenarios Dan and I have seen, or try to trigger some other ideas. The next one I put on my list, I took off my list last year. Employing your kids. For a long time, I hated this because so many people, I'm going to employ my kids. How much can I pay them? Well, $15,000 a year. Okay. And they start paying them $15,000 a year, and the kids don't do squat. Well, you are absolutely going to lose on audit if your kids don't do anything. Like, don't be silly. But then I've got this recurring memory. If my kids are watching this, I used to make them come to development meetings with me. Like, I remember my kids, I gave them a notepad and I said, sit down and listen to the meeting that we're going through and take notes. I remember looking at the notes at the end. I think they were like 8 and 10 at the time. And I looked at the notes and I said, you didn't understand a thing that was going on in this meeting, but I do see references in here that you tried. And I wondered back, and I've had them paint rental properties and some other things like that. I just wonder how much of that has helped them become adults now that they're adults. And I think here's a double benefit. Employ your children and make them do something. In today's world where we've got all this technology and people on TikTok and Facebook and doing all these things we probably don't want our kids doing, get them to do some work and pay them for it. And then you can use some of that money for whatever you want, private school tuition, sports, whatever, but get them to work. It's a great tax benefit. If you set it up right, they're not going to pay Social Security and Medicare. They're not going to pay income taxes on the first 15 grand. You got 3 kids, that's 45 grand of income you can shelter. Pretty good deal.
Although, now, do you have to have do the funds have to come out of a unique bank account, and would you set up like a family trust just with that entity name in it?
Without going into the details, we tend to like to set up a family management company. It sort of isolates the issue, which is a bad thing if you're cheating on your taxes, but if you're doing it right, it isolates the issue. If you have an S corp and then you're getting into an LLC where you're saving Social Security, Medicare, so put that in there. But you have to treat them like employees. You need a W-9, or I'm sorry, you need all the forms. I'm just talking too much here. You need an I-9. You need an employment agreement. You need time cards. You need a job description. Do the stuff you do for employees, right? And keep it in a separate segment so that it's really easy to see. This is how much I paid them. This is all in a nice, neat little box. And by the way, here's all the documentation. Real quick about the IRS. I don't know how many of you know IRS agents. They don't want to work hard, right? They need to show that they've found money in a relatively short time frame. So if you give them a mound of paperwork that they have to read through just to find out that you're actually in compliance and get nothing, that's not something they're going to go after. They're looking for the person who gave them a shoebox full of receipts where they can go back and challenge every receipt, right? So document if you're going to do this. Document the heck out of it and be ready for that audit. You slide a pile of paperwork, or your representative does, to the IRS agent and tell them, look, this is buttoned down. It's got a bow on it. There's no way most of them are going to spend the time to read it. So treat them like an employee. All right, Dan, you're taking this one away because this is yours. I've done this before, but I know you do this for yourself personally. So there's a thing called defined benefit plans. It is glorious. And it's way better than a 401k. So tell us about what's going on here.
The nice thing about defined benefit plan, and I think just to confirm before we get started, can the contribution go into the date or the year that your taxes are due? So if it's 2025, can I make the contribution in 2026?
Asking me a question that I'm not 100% certain of. When do you make yours? Because I know you do it. I'm pretty sure it's in April. Pretty sure you have until
It
April.
it would be April, and if you extend all the way into September, October, depending if you're sub S, I think. Okay, so defined benefit plan, it allows small business owners or self-employed to set aside funds for your retirement account. So you need a plan administrator. And so there's a process, and we can refer you to companies that do a very good job there. But if typical 401ks or 401ks or IRAs are limited to, I think, 40,000 or so, and let's just say your income is higher than that, and you'd like to set aside more funds, well, depending on your income, you can go up to 350,000. Now, there will be annual contributions going forward. So you'll plan out a strategy with an actuary. So these services use an actuary to set this table up for you. And then they'll define what that maximum, or excuse me, what the minimum amount is just based on your age and your income. So it allows you to take more money off the top every year on the front end. So if it was 300,000 and you're in the 33% tax bracket, you just took off $100,000 of taxes for yourself. So that's the benefit behind defined benefit plan. You'll have more money set aside in your retirement account, and you can reduce your tax bill this year. So that would be really why I think many small business owners do that is. And then last but not least, this is also true with the HSA, but depending on your age, you can get a catch-up provision. So I think you can go a little bit higher in the defined benefit plan, depending on your age. And I apologize, it might be 55 and older, so I qualify. I'm not Todd, but your HSA, you also get a catch-up provision, I think it's $1,000. So defined benefit plan, way to take more money off the top of your income, defer it for the future, and then you can work out a Roth conversion plan for later as well.
I like that idea, pair it with a Roth conversion. Just to be clear, the reason they call it a defined benefit plan, a 401k or IRA is called a defined contribution plan. They use the word defined to mean what it defines. So you're defining the benefit in a defined benefit plan. That's what allows you to get these really high limits. If you're 15 years old, you're going to retire when you're 65. This actuary is calculating how much you're going to need when you're 65. Well, you know, all these years to save for retirement, so you don't need very much. So there's maybe a low limit. But if you're in your late 50s, early 60s, and you go to this actuary and you do this math and say, look, I'm going to need $500,000 a year to maintain my lifestyle. So I'm making right now. They do the math. They go, oh my gosh, you got to put $400,000 in your account. That's the limit under the IRS rules, right? So you're taking these things that have low limits and you're throwing them out the window because of this other type of plan. We thought benefit plans went away in the 70s, but they haven't gone away for the right people. There's a workaround though I'm going to tell you about. I don't give away too many secrets in videos or on the internet, but here's one because it's not my secret to keep. The hard part of defined benefit plans, the reason you don't see them all over the place, if you do it for you, you have to do it for your employees. So if you've got 100 employees and they're all older, this isn't going to cost you a lot of money to do a defined benefit. Maybe you want to do that. That's fine. And that's perfectly okay. But it's an expensive endeavor for a business owner to do that because you can't just do it for yourself. There's a group, this is 20, 30 years ago, that of physicians that didn't have any employees. They created a 100-person physician group with no employees. They contracted out all of everything else, nursing, all the care, all of the other things. So all they had was these physicians. And they did this just for the defined benefit plan. All of them were highly compensated, but they passed all these tests and they got all these huge amounts into their retirement plan. And I'm not going to say any names or anything, but I had the pleasure of auditing their plan one year, not as an IRS agent. because you need an audit for plans that size. Before you file your tax return, the audit kind of goes with it. So I was doing that work, and it was a nightmare to audit because they also self-directed all of it. So money was going all over the place. But talk about a huge plan. It was just massive because these doctors were putting away massive money. So where there's really a will, there's kind of a way sometimes. You just have to get smart about how you're structuring things. So, maybe that doesn't work for your lawn care business where you got a whole bunch of people running around all summer getting stuff done. But, sometimes it's worth thinking about. Is there a way I can structure? Dan, the last one I got, we're going to run out of time before we get to too much more, but I've got on here 1202. I have to tell you, I've been telling people about this, and it's so surprising how few people know it exists and what it is. This is a small business stock exclusion. So I would bet you, Dan, don't you think? You call me once a month when somebody says, hey, they sold their business. They want to know what their tax strategies are. And I say, hey, did they do a 1202? And the answer is always no. And there's a reason. Go ahead if you got it.
I'm sorry.
There's a reason for that, though. That because when 1202 came out, when it was added to the tax code, it was really hard to be a C Corp back then. So the rule about a 1202 is you got to be a C corporation, and you have to hold it for 5 years, while C corporations pay double tax. And back then, the 1202 only exempted half your gains on a stock. So today, the way the rule works today, you invest in a new C corporation. Their size limit has to be under 50 million in assets and things when you invest in it. But you invest in it, you hold that investment for 5 years. It's a new issuance. There's some other things, nuances to it, but you do that, the first 10 million is tax-free. Has to be a C Corp, has to be a new issuance, has to be a small company at the time, but the first 10 million you have can be tax-free. If you got a wife and 3 kids, you invest on their behalf. Now you got 10 million each, you got 50 million you can do. First 50 million on the sale of your company is completely tax-free. Lots of states conform to this too. So if you live in the state of Minnesota like me, you've got an entirely federal tax-free business sale. You've got an entirely state tax-free business sale. You're going to walk away with at least 50% more money than you would have otherwise. This is a cool deal. You have to get on it now. You can't just simply say, I'm going to turn the switch and be a C Corp. There's a reorg that has to happen. You have to have a business purpose to reorg. Usually it's bringing in new shareholders or something like that. So it doesn't fit every situation, but I'm doing 3 of these right now. And I'm telling you that the tax savings are going to be enormous. This isn't a last minute strategy, but I wanted to include it in here because I feel like I need to preach the gospel here on this and get people aware of that. I did fail to mention only qualifies for certain types of businesses. So people like me, if you have a tax advisory business, those don't qualify for 1202. So I'm going to pay full tax when I sell my practice. But boy, there's a lot of areas where it works, and I think you got to look at it.
Is there a length of time again? Sorry, you may have mentioned it.
5 years.
Great.
Got to hold it 5 years. So we've got one company right now that, it's like giddy up because this company's growing really fast. So we got to get in another 50 million, and then they're anxious to sell because they feel like they've got really good momentum. They want to capture that on the sale. So, get the 5-year clock started as soon as you can. Well, Dan, I'm going to throw our contact info on. We've got 5-10 minutes here to chit chat. If people have questions, put it into the Q&A or whatever you want to do there, or chat, I think it is, in the Soho meets. But, over the years, you and I have done a lot of last minute tax planning. Have you ever seen anything like the way gas stations and leasing and things are today?
No. Yeah. Excuse me. So excited to respond. The opportunity to actually invest less, get credit for more, all in the same year that you invest or place it in service this year is significant. And at the end of the day, taxes are our greatest expense. Maybe sometimes we just take it for granted that everybody needs to pay a tax, but we don't need to overpay. Let's leverage the code that the government is incentivizing us to utilize, because if we're not doing that, they are doing it, and then it's disappointing to them because then it goes on their balance sheet and it'll get mismanaged. How many times have we heard that? So let's manage our tax exposure by leveraging the code, and bonus depreciation is one great way to do it.
And I'm coming out with another webinar. I think it'll be probably in January, where we talk about bonus depreciation and how it applies to real estate, because it feels like it shouldn't, but it does. And it applies differently to different types of real estate. So some really cool stuff in there. The home run everybody's doing is gas stations and car washes. They're explicitly described in the code as being less than 20-year property. You can depreciate the whole thing. You buy a gas station, you can depreciate the entire thing in 1 year. So even if you leverage it, right? So I had a client in 2020 when bonus depreciation last time was 100%. I might have been 19, that might have been 20. But he bought $15.5 million worth of gas stations. The land was worth 10%-ish, 15%. I think we had a $13 million deduction that year off these gas stations we bought in December. Never seen anything like it. It's insane. Now it's not everyone, but lots of people around the country are figuring this out. It applies to certain things better than others. So without going into too much detail here, if you're a real estate person, it does apply. If you're doing equipment, it applies across the board. Almost all equipment, things like that, are 5-year, 7-year. Computers, anything is depreciable for the most part. It's rare that it's over 20 years unless it's a building. So how do you get a building to qualify? Subject for a different day, but you can. Portions of a building up to 20, 25, 30, 35%, sometimes up to 70, 80%. Cannabis buildings, amusement parks, surprisingly, throw off a ton of depreciation. Golf courses. Do you think Donald Trump knew that greens, tee boxes, and cart paths qualified for bonus depreciation when he re-upped it to 100%? I'm pretty sure he had something in mind when he did that. But there's some interesting stuff out there, and I think there's a lot of plays that are going on right now in December. I wish people would have started in October, but right now in December, there's deals you can get in on right now that are just throwing off massive amounts of depreciation, and up to what, Dan, 2 to 2.5 times what your investment is, you can get a deduction for in that same year.
Yeah. One other area that I touched on right at the beginning, but tax credits, it's something that's pretty easy / efficient to make those decisions today. But transferable tax credits allow you to go ahead and invest in the tax credit. So transferable tax credits, typically they're less than the amount of the dollar of tax. So you might invest 50 or 85 cents and get $1 worth of tax value. So you can see it's 15%. So it's not
you make an immediate return. Yeah.
It's not designed to be an investment as much as taking advantage of the government incentive to solar projects, for example. So tax credits are also something that are very interesting. It's hard to find. So it's taken me years to find these. And fortunately, we have a few to take a look at. The other component on tax credits is you can do a look back on your taxes if you want to refile and get a credit against tax that you've already paid, and you probably just leave it there and apply it towards a future tax. But long story short, you can close into 2026 for 2025, I believe, too. So
I'm bummed I forgot that on my outline, Dan. Thanks for bringing that up. I will say, from my perspective, people used to hoard them, but it also, the laws have changed. It used to be that a lot of the tax credits, we're not talking about a deduction or a credit where it's dollar for dollar off your taxes. A lot of the tax credits either triggered AMT or they had other limitations that regular people couldn't take advantage of them. So they were mostly purchased by large corporations, the Medtronics, the Targets, the Walmarts of the world, were the buyers of tax credits. They've been democratized, if you will, by the Biden administration when a lot of those came out. Now, some of those got shortcutted by Trump in favor of bonus depreciation, but there's still a lot of plays out there in tax credits.
A great incentive.
Yeah. I mean, why not make something off of the money that you're giving to the IRS, right? At least make some kind of return on it. I know the guys, women, people, all the people of all, whatever, worked at these company treasury departments. So if you're working for Walmart and your job is the billions of dollars of cash that just sits there that you need to figure out how to make money with, buying tax credits to them was like a home run, because now they're like, we outperformed you guys in the stock market last year. I win tax credit deals. Legit. They would have years that were better than the people who were, trading short-term, holdings. So it's a legitimate business for real people now too. All right, I don't see anybody. Oh, we got a question. Yay, somebody used the Q&A.
Would
Yeah,
say,
okay, well, somebody said, do you want to open the last 5 minutes up for Q&A? So I think I said that a minute ago, but I talk fast. Yes, absolutely. Dan and I both have time on our calendars to finish this off for another 10 minutes. If there's a question, please answer it, or please ask it, and we'll do our best to answer. If I don't see anything in the next 30 seconds, I'm not going to make you guys stay on, watch this, but
and otherwise you have our contact information as well.
it did. I should put it back up again real quick. And I hit the wrong button. It was up. He'll be fine. You know how to reach us. The email that you registered from, respond to that. I'll track us down. There we go. Sorry, I just hit the wrong button. Here we go. Contact. Bingo, bango, bongo. Dan and I are also really mediocre golfers. So when summer comes back around, QCDs. Dan, have you done any QCDs for clients?
Maybe I'm not recognizing the acronym, so maybe you can touch on that.
Trying to get a good description. Oh, I forgot. Sorry, it did. I had to dig in for a minute too, because I don't deal with retired folks very often. So qualified charitable distributions from a IRA, I believe, is what they're talking about. That's a newish rule that allows you to say, I have an IRA. IRAs are horrible things to give to your children because they're a tax problem that never goes away. So giving your kids real estate that gets a step up in basis is a fantastic way to make old tax problems go away. IRAs are awful for that. So we just settled in a state for a really wealthy real estate person, and they had a small IRA, just gave it to charity, just gave the whole thing to charity, right? So it's basically the same idea. How do we, if you're going to give money to charity anyways, that IRA is a fantastic asset. I kind of feel bad that you saved all these years and put money in an IRA just to watch it go away, but you're going to lose, 40% of it to taxes anyways. So pretty good asset to give to charity.
I would do a conversion the asset conversion if we can help you.
That's what we're doing with our clients is Roth conversion and get it into a non-tax or a taxable account at some point, and then we can do other things with it. And we shelter that. We didn't talk about this too much, but the Roth conversion is going to trigger income, but we use other tools to shelter that income, the tax consequences of that income, right? So we look at a holistic plan where we might purposely create a tax over here in order to get it out of this vehicle. And then over here, we create some kind of a deduction. What you're talking about with the QCDs is just shortcutting that. Just not a huge fan, but I don't have anything against them. I don't usually bring it up.
Yeah, you're either getting it in a lower bucket, taxable bucket, or your income in a lower taxable bucket, or you can do an asset compression program. So getting a few more questions here.
Yeah, I love it. Here's an explanation of the QCDs. Says your charitable donation, right? Hold an XX, the donation counts towards owner's RMD. That's a good point too, is the RMD, but again, still a fan of let's trigger that tax in that IRA that you've got, and let's find another tool to shelter it. So we've got other ways to create tax losses to offset that and take the pain away that don't involve necessarily giving it to charity. If you want to give it to charity anyways, and you're choosing which assets to give, IRA is a good one. Highly appreciated assets that don't have liabilities associated with them. So real estate's tough because you usually have debt on it. But yeah, okay, back to what else there's. Should my age 24 son do a Roth IRA now for 2025? If so, how much? So first thing, you got a job, do the HSA, max the HSA. And like Dan said, you can self-direct it.
And if you're working for somebody else, the employer contribution, so your contribution and matched.
There's an HSA match for sure. Now you got a home run. If you have a 401k plan and there's a match, that the math to that is going to be superior than a Roth IRA. Here's the one thing I will say. Now, look, Dan, you're an investment advisor, so at the risk of offending your profession, I'm not a huge fan of like managed accounts where someone else is managing your money. I think sometimes they work out wonderfully, but where they really work well is if you're terrible at managing your money. We want to get it out of your hands and into a professional's hands. Roth IRAs make a ton of sense, right? Like either they're irresponsible or they just need a forced savings account, like do it per paycheck, do it whatever. Like those type of things that's a home run because you're saving yourself from overspending. Okay. But
I think just as a note, you can also go self-directed and be as creative as you want. And, hopefully you are working with a professional to give you good advice. I think one of the notes there behind 24, does that imply that they're in a lower tax bracket? So maybe the Roth is helpful there. And yes, it can go into a fund or it can go into self-directed, but maybe at that tax bracket at 24, maybe you're getting a little bit more of a benefit. I don't want to assume that they're not the next Mark Zuckerberg and they're already hitting it out of the park at a younger age. But maybe that was one of the questions there. But the other thing is some RIAs and advisors do a great job. I used to pay an RIA to manage assets too. However, I found that I was doing a better job. I was just helping my clients and I really enjoyed doing that, but I wasn't doing it enough for myself. And some RIAs do a phenomenal job. I just don't think that you always need to pay 1.5%, 2.5%, 2% a year to get the same benefit.
Yeah. I'm going to get on a soapbox for a second here. I hope you don't mind. Number one, what does a Roth IRA do? You put money in, you don't get a deduction for it. Okay. And it grows tax-free. Then when you take it out, you don't pay tax on it. Okay. That's the benefit, right? If you buy a stock and you hold it, you put money into the stock market, it doesn't get taxed. It grows as long as you don't take it back out. As long as you don't sell that stock, you buy one stock, you have it there. Or especially if it's your own company, investing in your own company, that grows, also growing tax-free if it's a stock, right? So it's a company that's throwing up income that's taxable, but it's throwing up income, which you're getting the benefit of. There's ways for things to grow tax-free, just like a Roth IRA. But when you get to the end, let's say you've held the stock for 30 years and it's a publicly traded stock, you can borrow against it and pay no tax on that distribution. You can get literally the same effect as a Roth IRA if you are actively involved and you know how to play those games, right? So if your 24-year-old son's responsible and can get after it and make these good decisions, I think you can get the same result, but maintain control of your money, right? That's the thing, right? If you need it, you can still pull it out. You put it into some type of a custodial account or managed account or something like that. You're giving someone else control of what they're doing with it. But the real home run that I've seen people create wealth with is not Roth IRAs, it's real estate. And the thing about real estate is if you've got extra money left over and you can invest in something, it's going to not only grow in a tax-free manner, it's going to throw off paper losses of depreciation that are going to offset income. So you're going to get tax-free income. Then you can do 1031 exchanges and keep rolling it from one investment to the next. And pretty soon you turn around and you have a real estate portfolio that dwarfs your buddy's Roth IRA. But it's not for the faint of heart. It's a business. It can be a side business, but you can't ignore it. You have to work it. So I would say it just depends on what your 24-year-old son, what they need. I have one son, put it in the account. Like he doesn't need to be managing, he's busy doing other things. Another one, put it in real estate. Go ahead.
You brought up a good point, and I meant to mention this earlier. So on bonus depreciation, yes, you get to write off the entire value today, so the year that you put it in service. However, now your basis is zero. So as Todd just mentioned, the typical process is to do a 1031 later, so you can take your equity and growth, defer capital gain, defer capital gain, defer capital gain. Hopefully you're working in other assets that will be providing income for you and protect that equity and reasonable business plan for appreciation. But it's all based on really where the markets are at that time. But 1031 will help you defer it and then do the estate planning and then put it in your estate. So the eventual asset holder will get a step up in basis.
Yeah, please. I mean, I know that people in Congress can watch these videos. Please don't tell them. But man, buy real estate, use bonus depreciation, 1031 exchange, put it in the right kind of trust, get a step up in basis. You can get out of estate tax, income tax, the whole thing grows tax free. Like I always say, don't let the tail wag the dog, but man, that's a pretty big tail if you do it right. So I like that. There's one last question, Dan. We'll do this real quick and then we'll let everybody go. Does taking Social Security at age 62 make sense as it takes till 80 to break even? What if I make money when in my 60s? Does that affect what I can take? So I will say this. This is a math question where you got to do the math and figure out your personal life expectancy. So I'll tell you two things. Number one, it always boils down to how your health is. Okay, so my mom died at 73. So does that mean I'm going to die at 73? Maybe, but my dad's like 90 and still kicking it. So I don't know what I'll probably kind of somewhere in between there, right? But if I knew that I didn't have a long fuse, that changes the whole Social Security equation. Take money now while you can get it while you're alive. Okay, so sometimes don't let the tail wag the dog on the tax thing. The other thing that advisors will tell you, this is what I hear them say because I don't do this math, is that there's so many variables that the future is just so unknown. In your case, if you have taxable income in the current year, you're going to get whacked on your Social Security. But sometimes a bird in the hand sort of theory holds. Dan, have you done this math with clients before?
Yeah, good question. And I understand where you're going with that. It's probably best just to do a little research. I can put together a summary fairly quickly. But yeah, I think it's better for me to take a step back, ask a few more questions. We can do it all by email if that's better for you. But I would like to at least do a little research and put it in a summary.
Yeah, that's my 2 cents though. Figure out your life expectancy. Take the money, bird in the hand. There's your advice. Okay, I'm gonna. Oh, and somebody says thanks. You're welcome. That's it. We're out of time. Dan and I got businesses to run, but thank you so much for jumping on. Please feel free to reach out if you have anything else. Very qualified people here, and if we can't solve it, we can find somebody who can. So I appreciate your time. Dan?
Thank you, everyone.